Okay, let's answer some questions from Sunday's market outlook. Now that we have a full trading day behind us, it's Tuesday night as I do this. We saw a little bit of AI foolishness in the early part of the trading day, and it sort of went away. Nvidia hit a trillion, just to say it hit a trillion, and then it sold off after that. And there were just some odd signals all day in the market. You know, commodities and commodity producers are trading like it's recessionary times, yet tech is trading like we're in a wicked expansion. So AI, that's what it is. Every company now, it seems, as I look through my news feed, is saying that they're using AI for something or other. They're using AI for this and AI for that, trying to get in on the hype. Okay, let's begin. Finally, I know Mark also listens to the All In podcast. Yeah, I like listening to people who do their thing, not people who claim to be experts in something they don't do. These guys are all in the VC space. They have a window on something I don't have a window on because I'm not in the VC space. So they see where money is going, what's being funded. They have a particular outlook on things that I find is interesting. What I find less interesting are their views on politics because, well, everyone has a view on politics. I really would like it if they stuck very closely to that to their wheelhouse, but they are interesting. It's well done, and I do enjoy listening to it. Let's see. I also feel the lag is stretched this time, probably because people and businesses refinanced heavily, making the impact latent. Would not be surprised that it could take another few months or even a year to give time for loans to reach renewal dates. Yeah, there was, I saw a video on YouTube, a guest on CNBC saying there are no lags, rate hikes are all in the market right now. And I thought, why do you let these people on? I mean, don't you vet these people first? They're all in the market right now. So somebody with a 30-year fixed rate mortgage at 2.9%, you're telling me they feel the full effect of the interest rate hikes. That's what you're telling me right now. Come on, man. Anyways, there's somebody who believes there are no lags. They work immediately. I'm sure he's never heard of an interest rate swap. He's never heard of a fixed rate loan. Seems odd, right? Maybe I should be on CNBC. Maybe I might be one of the most informed guests on CNBC based on the types of people I see on the clips. I know I'm more informed than Kramer. I'll tell you that much. What do we got? After having passed level 2, I started to get more involved into trading. I was wondering, especially in the current market, what do you usually look at to determine if trading session poses a context of risk on, risk off? Couple of things you can look at. You can look at where bonds yields are headed. You can look at where the dollar is headed. Risk on, usually DXY is going down. The DXY is dropping. Bond yields tend to be rising, but certainly not dropping. In other words, bond prices are soft. And the more cyclical and the higher beta sectors are leading in the rally. So if the S&P is up 1%, I look at XLK, XLY, the more cyclical or the higher beta sectors, they're leading. And it wouldn't be surprising to see XLP lagging by quite a bit, maybe XLU being negative, the utilities. So you can look at those sorts of big, broad indicators. What things could one look at before the trading session to get a sense of how the risk session will look like? Oh, before the trading session. Well, you look at futures. They trade all night long. Although I don't think the futures mean very much until you get to about 6 or 7 a.m. in the morning. So here's about, call it 6 to 7 a.m. And here is 11 p.m. In the evening. And you could see, if you're watching ES, you might see plus 12 points. That's meaningless. Not until the Americans show up does it start to tell you what sentiment is going to be. Not that I'm picking on the Americans in any particular way, but it is their market. And they tend to be more, if you're going to have a continuum of risk-seeking. Americans tend to be more risk-seeking, or at least less risk-averse, so that they are more willing to create and participate in rallies than most other markets are, without any catalyst. That's like the Japanese market is going up for big reason. The yen is weakening. When the yen was strengthens, as it did in the last 24 hours, you saw the Japanese market pull back. Same with the Mexican market. If you're looking at an ETF tracking the Mexican market, as the peso gets stronger, it just goes up. I mean, the U.S. market does not need the dollar to have a rally. So usually once you get to 6, 7 in the morning, have a look at where the futures happen to be. I know, for instance, one can see stocks going up, but I feel that at the time we are at a risk on. In other words, having previously missed the point that it was going to be a risk on session, if that makes sense. I see what you mean. That how do you know when I should proceed into the intersection, when the light is green? But when I get to an intersection and the light is green, it's already been going on. I missed the beginning, is what you happen to be saying, is that you showed up and the party was in full force. I don't really know, because again, the futures used to provide a signal. You could look at Globex before you went to bed. You could see where the futures happen to be, and that would pretty much be where you would be the next morning, barring anything really fantastic or terrible happening overnight. That sentiment would pretty much carry over. Now, it's disconnected. I could see at 11 p.m. futures down 40 points. And that's meaningless. That gives me no idea of what's going to happen at 7 a.m. when the Americans start getting into the office. That by the time the market opens, you find you're up 20 points. And whatever was negative down here does not matter over here at all. Just doesn't matter. That's been going on for a while, where the signal is lost. So, from day to day, I don't know. I look at the market and go, I don't know. And it seems that, if you don't like the open, come back in 45 minutes and you'll see some red bars. Come back half an hour later and you'll see green bars right up the side of the chart, like V-shaped recoveries intraday. I don't know anymore. It is a schizophrenic market that sometimes some pockets are perfectly rational, other pockets are irrational. There are days where the entire market seems rational and days where the entire market seems completely irrational. It almost seems that we are at the height of randomness, the depth of any kind of predictability. Let's see. I'm mainly referring to U.S. equity. I thought you were, because it is probably the most difficult market to figure out what anybody wants to do that day. Even today, as I was looking at the market, I was talking to the person I work with here, the new employee I have, and I was saying I don't think I'm playing against humans, because this doesn't make any sense. The moves that I'm seeing, the signals just are so contradictory. I don't think I'm playing against humans anymore. Let's see. How do you distinguish between real trends and fake trends? What research methodology or key indicators do you use to come up with your conclusions after formulating your hypotheses? It is. I think there's always like what they call the sniff test, right? Does it pass the sniff test? If I look at something and I can see a bunch of uses for something, or a bunch of applications, or a bunch of instances where this can happen, or I see major gluts or major shortages that cannot be resolved anytime soon, those tend to be real trends. Some are fast moving, some are slow. So when I saw the internet when it was first introduced to me, it was like 92, 93. Somebody approached me to set up an ISP, an internet service provider, and I hadn't heard of this yet. I was aware that there was a communication systems between universities that was, that this was the basis of, but I hadn't been aware of the commercial application for it. And what you would do is you would contact your phone company and you would buy a big chunk of bandwidth. And then at your location, you get this big chunk of bandwidth coming in. And at your location, you'd set up a whole bunch of 56K modems. Oh, yes, 56K modems. Look at that. I'm dating myself, right? 56K. And then you would sell access to the internet to people. And I looked at this, I looked at the numbers, and it looked pretty good. And one thing that got me was, well, what's stopping Bell, because that's who we had to buy the lines from. I said, what's stopping Bell from just doing it themselves after all these small service providers start proving the market? And Bell sees that I'm paying my bill every month. Bell will figure, well, you must be selling it if you're paying your bill every month. And if every internet service provider is paying their bill, aren't we creating the biggest, baddest competitor in the world? Aren't they just going to use us as guinea pigs? Oh, no, never happened. And I thought, nah, but it will. I knew it was real, the internet. I knew that was real because I could see all the use cases right away. It was incredible. Mobility, the cell phone, I knew that was real. The BlackBerry, the moment I saw it, I knew that was a thing. Bitcoin, no. Couldn't see it. I thought about it. I'd hear all the explanations. It'll do this. You can do that. You could do this. And I thought, but why? Why? I have no problem in my life that this would solve, and I have nothing in my life that this would enhance. I could see no use for it, which meant the market was really, really small and really niche. So I never got on board the crypto thing because I still think that's a big, giant pile of nonsense. But people in the crypto market, much like, anybody who believes anything to their soul, you're not going to convince them any differently. And their usual reaction is to simply call you names if you insult their God. But, I think it's a big pile of nothing. That's a fake trend. But that doesn't mean you can't make money from a fake trend, because some people have made money. And it doesn't mean you can't lose money from a real trend, because a lot of people lost money in the dot-com boom. So it's a matter of, ask yourself, can you see this in your life in any way whatsoever? And if the answer is no, it's not really a trend. It's a fad that will go away. I think that's what you were asking. What research methodology or key indicators do you use to come up with your conclusions? It's just, I guess I just explained it. If I can see a reason why it would be in my life, then yeah. Want to run an idea by you. I've been going through the applied series, and I like the idea of having a theta target. Just want to see if this is a sound strategy. Sell 0.2 to 0.25 puts and calls. Only sell calls on ETFs with liquid options at 30 to 45 days to expiration. Set DDB of industry based on economic cycle and macro indicators. Okay. XHB would be bullish due to shortage of housing, while XLE would be neutral or slightly negative. So in this, are you suggesting that because XHB is bullish, you'd move closer to the 0.25 on the puts, and XLE you'd stay closer to the 2, and for XHB on the calls you'd move it to the 2, and XLE you'd move to the 0.25? Do you get what I'm saying? Because you think XLB is bullish, you'd move your puts closer to the strike, but you'd move your calls further up. Is that what? If that's what you're saying, yeah, I kind of agree with that. Although if you're bullish on something, I would not be selling calls unless I already own the underlying. So if I'm selling puts and some of them are put to me, then I would also sell calls and puts at the same time. But selling calls. It's I would rather wait till I own the underlying before I sell calls, unless something is sideways channel. So you say XLE is neutral to slightly negative. There you could probably sell calls on XLE, but be careful. OPEC has gotten very used to 70 plus oil. They've publicly stated before that they see 70 as their floor price, and they are willing to use supply as a weapon to hurt the short sellers. So be careful with XLE. Take profits at 50, close losses at 100%. Now this take profit at 50, be careful with that. You don't necessarily have to take profit at 50. You take profit at 50% if you're facing gamma risk. And if we look at gamma as a distribution, it would look like this, not as smooth as this, but this would be at the money. In other words, if this is gamma on the vertical, gamma is the highest at the money. If you sold a put and the stock price is way up here where you're way out of the money, well, I don't know about taking profit at 50% at that point. It's like, why not let it run for a little bit longer? And if you're 10 days to expiration and there's still some premium left and there's a good story behind the stock and you've got very low gamma because it is so far out of the money because the stock price is up here that gamma is not really a risk to you, let it run. Where you want to take, where you're thinking about 50% is, let's just draw out a stock chart here, and let's say the stock's doing this. You sold a put, let's say, right here, and the stock price is doing this kind of stuff and hanging out kind of close to your strike price, and you've got maybe 10 days to expiration left. But you had maybe, let's say, 45 days up here. So you've made quite a bit of premium already, and you have high gamma risk because the stock price is close to your strike price, and it could do that. Then at that point, take your gain. But to have a rule always of 50%, what if you have such a wide margin between where the stock price is and where it has to get to hit your strike? Target theta 0.2, determine allocation of industries based on theta. For example, if theta target is 100 and I want 20% allocation of home builders and puts XB2 reaches theta. Yeah, that makes sense. Because you're basically, it's almost a proxy for sizing it for the volatility as well. I'm going to test it on paper trading account first, but just want to see if there are any major flaws. No, not really. Why are levels with the highest gamma concentration very strong resistance? I always knew that at these levels, market makers may not let the price go. Well, to say that strong resistance happens at the highest gamma would mean that every single price has the highest gamma no matter where the stock price happens to be, because gamma is the highest at the money for strikes. If you have an at the money strike, you'll have the highest gamma. So no matter where the stock price is, to say that it has the highest gamma is kind of like an identity. It's like, well, yeah, if you're looking at a strike price at the money, it will always have the highest gamma. So it's not that highest gamma offers resistance. It's that if a stock hits its resistance level, a strike price at that level would have the highest gamma. But it would have the highest gamma even if it wasn't a resistance level if you're looking at an at the money strike. So I don't know that that's true. Previous Q&A, you said trading on a moving average. Can you show and explain this clearly? Trading on a moving. I think you mean when I'm selling puts. So I'm doing that on HXB. So here's a timeline, and let's say we're today. I will go out 2 weeks and I will sell a put at 30 delta. Then when it gets to this expiration date, I'll go out 2 weeks and sell another 30 delta. This one will expire. I'll go out 30 weeks, sell a 30 delta. This expires. You see what I'm doing? I'll always have two options open every time, and I'll have an option expiring every single week. And that's because I want to collect shares. A 30 delta means there's a 70% probability I will not get the shares and a 30% probability that I will when I first open them. So let's say that XHB is doing this kind of thing, right? And if I draw the timeline, let's say these are the particular weeks where I'm selling 30 delta. So 30 delta might be here, 30 delta might be here, 30 delta here, 30 delta would be here, 30 delta would be there, Notice that you're getting it on a moving average, because 30 delta would be a certain distance down from wherever the stock price happened to be, assuming a volatility that stays within a range. If volatility is changing, well then your 30 delta might be here this week, and because it dropped down, it might be here, so you might have something that looks more like that. But if you are selling on a consistent basis, 1 week, every Friday you sell a 30 delta put on HXB, it will follow a moving average of whatever XHB happens to be. Let's see. I'm just about to start level 1 and have been watching some of your old 2019 20 level 1 videos about the ideal starting order with quant, FRA, fixed income. Is this still applicable, or do you explain this in your... Yeah, you can start with quant because quant forms the basis of everything. However, the person I hired is preparing for level 1 and started with fixed income. And fixed income uses a lot of quant. And then went on to quant. And what she is saying is quant makes a lot of sense, because as I'm reading quant, it's answering a whole bunch of questions I have about fixed income. And I've always said that it's better to read something with questions in your head than to have no questions. When you have questions in your head, you will recognize the answer when you read it. But if you have no questions in your head, you won't know what's important and what's not. So maybe there might be some value in starting with the topics that use a lot of quant first, then going back to quant, and as you're going through quant, it suddenly starts to clear up things, or to reinforce and make a lot of sense about the things you saw where you struggled with a bit, where you said, oh, now that makes all the sense in the world, because now you're learning quant with questions in your head. Yeah, there's some value there. I don't mind that. Also ridiculous, like you mentioned, the market has seen 99 before. No one seems to care or have any sort of hesitation in AI. Yeah, the hype is the same, and the people who were around in 99, you have to keep in mind that was 24 years ago. So if you were 35 24 years ago, you're 60 now, or if you were older than 40, you're probably retired, and you've retired with that history. You've retired with the knowledge of that history. So that if you've come into the market sometime in the last 15 years, you got 15 years behind you, you didn't live through that. You can read about it, much like we can read about the tulip craze in Holland 400 years ago, but unless you were there and you heard the talk and heard the buzz and saw the headlines, you wouldn't recognize them as having the same flavor. So it could be that enough people just today simply weren't in the market at that time. What else we got here? I don't disagree that there's a lot of hype in the market regarding AI at the moment, but I think it would be unwise to estimate the impact it is going to have. Now, I'm not underestimating the impact. In 1999, I did not underestimate the impact the internet had. It was going to have an impact. But what was untenable were the valuations. That you had valuations on some companies where they would have to own 100% of the market for 40 years to just return your initial investment based on the valuation. And anybody who thought about it for a second said, even if all the bricks and mortar sales from this company went to this one online business based on this valuation, and assuming a higher margin because you're selling online, if you're selling at the higher price, based on this valuation, it would take 40 years to return the money to shareholders, and they would have to own 100% of the market unchallenged. There was no possible way that that could happen. So there was no possible way that you were going to earn that valuation. The only reason you were buying it was why you buy Bitcoin, because you think you can sell it to somebody else for a higher price. That was the only reason people were buying it. So I am not underestimating the hype. The valuations are overestimating the impact that AI will have. It is not ready for prime time at this point. For wide adoption, it's not ready. It makes a lot of mistakes. It has copyright issues. I have the version 4. I pay for the version 4 of Chat GPT. I ask it questions. It is infused with ideology. Just to be clear, I asked it to do something today to see what its ethical programming was. And it says, this is against my morality or my ethics. I will not write something that is cruel to. So I said, write me a breakup email for a girl I no longer love, just to see if it would do it. And it said, nah, you should have a conversation with him. I said, I insist. So it wrote a letter. And next, we prompted it to be more cruel. Nope, will not do it. Why not? It's against my ethical subroutine. Well, whose ethics are those? Whose ethics? So we started asking it some other questions. And it does have an ethical bias that is not shared widely. So all of these things, when you look at it, you say, okay, well, now the bias of the programmers are infused in this. What else is in there? So to rely on this sometimes to make decisions. I don't know. Now I'm using a pretty weird example to say, well, what does that have to do with productivity? It's that it should not think. An algorithm should take inputs and produce outputs, and this thing is thinking. And some of the answers are wrong, especially when it comes to more difficult compounded questions. So it's not ready for prime time yet, and it probably won't be ready. By the way, did you read the story of the lawyer who used this? I think was in the Wall Street Journal. The lawyer who used Chat GPT to go to court, and he was citing, what was the case about? He was somebody on an airline had their knee hit with the cart, the drink cart that goes by, and was suing for damages based on being injured by the cart. And the lawyer submitted a brief to the court outlining all of these previous cases where a cart hit a passenger and there was an award. So there is precedent, Your Honor. The problem is none of these existed. And he relied on ChatGPT to write the brief. ChatGPT came up with all of these precedent cases, and they were all made up. They were all fabricated. None of them existed. So it's just not ready at this point in time. Much like most of the dot-com businesses in the late 90s, were never really going to be viable online businesses at that time. And many of them just simply disappeared. I think a lot of the a lot of the businesses coming out saying AI this, AI that, probably the promise of it probably is not going to show up. So I don't think I'm underestimating it. I put together the below auto-generated YouTube transcript. I thought you might find this interesting. This was just for nominal rates, main points, stats, figures. Yeah, I'm not going to go through this at this point, but sure, it could probably do something like this. It could probably summarize something. But again, you have to have a level of trust that it's right. Now, if you have to verify everything, it would take just as much time to look it up yourself, right? It will get there. Much like in the late 90s, 99, 2000, some of the dot-coms that were showing up were ridiculous. But it was going to get there. It was eventually going to get there. It just wasn't time yet. And I think AI will get there faster than how the internet got there. But it does not justify the valuations and the hype that we're seeing today. However, it's probably going to happen anyways, unless we get a recession that overrides the hype, unless something bad happens that overrides the hype. There will be hype. There will be hype. Right now at the official iShares webpage, TLT is listed with a yield of 2.9%. Well, the yield of 2.9% means that the you buy TLT for $102, and the dividend that it pays will yield you 2.9%. A yield to maturity of 4. The yield to maturity is probably the portfolio that they're holding, a yield to maturity of 4%. But the stock itself, the ETF itself, is yielding 2.9. I understand that the difference is because many of the bonds currently held in TLT are trading below par at the moment. No, not really. You got 4%, which if you look at the 20 to 30 year bond yields, they are sitting right around 4%, right? Let's have a look here. Let me just flip over. If I look at the 30-year bond yield right now, or at least on Friday's close, it was 3.96. The 10-year was 3.8. The 20-year is 4.13, and TLT hangs out around the 20 to 30. So yeah, that's about the right yield for where they happen to be. I understand how yield to maturity actually materializes in an ETF that is currently rolling bonds, and therefore don't reach maturity. Well, you have to have some quote. Yield to maturity is the best quote. So let's think about something. Let's say that you are forecasting bond returns, the expected return on bonds. Where are you going to start? Typically, your best starting point is your yield to maturity. And then you determine what your holding period happens to be. So let's say that my investment horizon is here. Right? And then you compare that with the Macaulay duration of the portfolio that you have. This is a starting point. Now, your job is this. Since my, let's erase investment horizon. Let's say that's the Macaulay duration of the portfolio, and this is your investment horizon over here. Your question is, what dominates? Reinvestment risk or price risk, right? If price risk dominates, my yield to maturity will be something lower. If reinvestment risk dominates, my yield to maturity will be somewhat higher. So I'm told here we got a yield to maturity of 4%, and my investment horizon might be 2 years, and I have to ask myself, over the next 2 years, do I expect yields to go higher or yields to go lower? If I expect them to be higher, I can anticipate an expected return greater than the stated yield to maturity today. I may not know exactly what it'll be, but my belief it'll be higher than the yield to maturity today. But if I think that rates are going, if rates are going, I did that wrong. Let me back that up a minute. Let me back that up because somebody out there is screaming at me. I can hear them right now. If you think yields are going up, you have price risk because you're going to have a capital loss, which takes time to break even, but you're going to be reinvesting at a higher rate. But price risk will dominate until you hit the Macaulay duration. So here's our investment horizon. Price risk will dominate. Your yield to maturity will be somewhat lower. But if you think yields are dropping, then you're going to do well on price, but not so bad on reinvestment, which means your yield to maturity will be somewhat higher than what it is quoted today. So the yield to maturity is your starting point, and what you have to do over the investment horizon is determine which dominates. Whether or not if yields drop, then your yield to maturity will be higher. If yields rise, then your yield to maturity will be lower. Now, if your investment period was beyond the Macaulay duration, then it's the opposite. So it just gives you a starting point. What else we got? What I'm trying to understand is what is the real yield an investor actually gets, regardless of whether it is gained via distributions or via embedding into TLT price. The real yield. Well, that would be your realized return, whatever your realized return happens to be, adjusted for whatever your level of inflation happens to be. And that would be your real yield. When do you think you will have the charter holder package open? Could you go into detail about this package? Yeah, this fall. Not sure what the exact date is going to be, but it is this fall. It will include the applied series. It will include certain monographs. So CFAI does publish specific monographs, and some are worth 2.5 hours, some are worth 6 hours, some are worth 1 hour. So something that's worth 6 hours might be about 200 pages on a particular topic. So a good one they have is VIX and volatility. They publish a monograph so that you can dive a little bit deeper into VIX and volatility. So I'll do selected videos on these that serve my purpose. In other words, I'm not doing it just to do them, but they have to serve my purpose in that there are some parts of this that I can then send to level 3 or level 2 because they make sense as extra little seminars to help understand a concept better there. And if I'm picking and choosing from some of these monographs to do some extra little bit for level 2, level 3, I may as well do the whole thing. And then it'll be new readings. For this fall, it would be whatever new readings showed up in 2023. It won't be the current. They'll be 1 year off, which means when you get to the fall of 2025, it would be only the new readings that appeared for 2024. Now, the content is switching to a modular approach. That does not mean those are new readings. It's just the same content broken up in modules. If it is a new reading altogether, then it'll be included. Some readings migrate. So, for instance, simple linear regression migrated from level 2 down to level 1. Well, it's a new reading at level 1, but if you think level 2, level 3, level 1, it is not a new reading to levels 1 through 3. You saw it at level 2, it just migrated to level 1, right? Some behavioral finance migrated from level 3 down to level 1. A new reading at level 1, but it is not a new reading for CFA. So the new readings would be 1 year off. So you basically buy the series, and it is an annual subscription because it gets updated with the new readings each year. If you have the applied series already, then it would just be the incremental cost to add on the charter holder package with an annual renewal, knowing that you're going to get some of these each year. Enough to make 20 hours, because you do have 20 hours of continuing education. I will do enough of these that they total 20 hours. And then whatever new readings. That's kind of the big outline of it right now. Then we talk about it. Does it make sense? Is there something else we could do? Is it too much? Is it too little? What's a fair price? And then we go from there and figure out, well, does it make sense? I'm curious to get your views on VC and funding AI versus everything else. Beyond the low growth economic environment on the horizon, do you believe VC funding will also take a hit based on the liquidity issues and fallout from the banking failures like SVB? If SVB was the primary banking partner of VCs, wouldn't funding slow down there as well? VCs get their money from accredited investors, right? And then they put their money in a bank somewhere. And then that money then gets deployed into target companies, into investments. The bank was not funding the VC. So no, I don't think so. Based on liquidity issues. Well, VCs portfolios are by their nature always illiquid. These are private companies. They are illiquid by their nature. So I don't think a lack of liquidity scares a VC. Do you plan to cover infrastructure as an asset class? Mining, oil and gas, highways. Well, that's not really like mining, oil and gas. These are commodity related. That's not really infrastructure. Infrastructure tends to show up in what are called PPPs, public-private partnerships, and some of those are publicly traded. There are, I think, in the infrastructure channel, you can invest in some funds that hold infrastructure assets, but I think it's probably better to invest in those companies that are the engineers of the infrastructure. So, looking at some of those companies might make a lot more sense. Just signed up for the applied course. Oh, good. Once the debt ceiling charade is resolved, Yellen will have to fill the general account either by issuing bonds or, some pundits argue, by trying to divert some of those $2 trillion sitting in reverse repo into short-term bills. Yeah, if the market allows the yield to be equal to what's in the reverse repo. If she chose the latter, what would be the actual mechanics to make it happen? Just issue T-bills. If there are enough T-bills out there with nice tight bid-ask spreads, they'll be taken up. It would take probably daily issues, issuing a certain amount every day for a period of time to create enough of a time frame for it, or at least if they're being issued that have to be, well, if you're issuing all 30 days, you wouldn't issue them all at one time. I mean, you'd have to spread that out over a period of time. You'd have to issue 30s, 60s, 90s, 120s, and then maybe 15 days later do it again, so that you always have some T-bill maturing on some date somewhere. You need enough one-day T-bills, two-day T-bills, three-day T-bills, four-day T-bills in the market, right, to create that liquid, time period where you can choose 1, 2, 3, 4, 5, 6 days. If there's no one-day T-bill, then I got to use the reverse repo. But if there's daily there's T-bills available that mature in 24 hours in one day, then I no longer need to use the reverse repo. So you have to issue for a while to fill it, so that in 30 days or 60 days you suddenly have a nice supply of T-bills maturing every day. So that's how I think that's how that would play out. Other than Bloomberg, do you know where I could get the chart of the MBS spreads? You might try OpenBB. I've never been able to get it to work on my computer, but apparently it's a thing. People talk about it. OpenBB is a Bloomberg terminal for the retail investor, all from available data that's available freely, which Bloomberg does a lot of that, by the way. A lot of the data that you get on Bloomberg is just aggregated from free sources. They just do a lot more data analysis with it for you, right? Well, this OpenBB will do that, and if everybody's contributing it to it, then it starts to, get a lot more power. So you might want to look at that. Update channel description. I just deleted the channel description. I don't know what to call it, so I just deleted it. You mentioned you backtest option strategies using Excel. I'm running into trouble getting the premiums I would be getting since they change daily due to theta decay and IV. Well, I don't bother with that. When I'm backtesting something, I'm not doing it every day to figure out if I should cover or whatever. I backtest something to see if it gets put to me. How many times it fails, how many times it would be put to me, and does it, if I'm selling 30 deltas and I backtest it and I find that 30% of the time it's put to me, then I know that, that it's following the distribution fairly closely. But if I run it and I find that it's only being put to me 10 times, I'm most likely looking at an upward trending stock that's not pulling back very much, in which case, I would have been better off with a 0.4 delta. So I just look at, is it put to me or not? I don't care too much about the nonlinear pathway that it takes to expiration. So I don't really backtest the actual pricing each time. That can get expensive if you want that kind of data. Recently, we saw significant weakness in the MREIT sector. Tracking analyst agency says to build a position. What could be the reason for such a price drop? Well, the debt ceiling did one thing to it, because as soon as the U.S. got put on negative credit watch, anything that was U.S. proximate or U.S. government related, including the agencies, got put on negative credit watch as well, which included Freddie and Fannie, which issue agency mortgage-backed securities. So that was a bit of an issue. You'll notice that today, again, agency had another beautiful day. Agency and Annaly, Friday, on hopes of a debt ceiling deal. They went up, and today they went up again because that fear is now coming out of them. What could be the reason for such a price drop? Well, okay, so I've already answered that. Few questions regarding implied volatility. This chart discussed at 56.28. 56.28. Well, I'm not going to go back and look at it, but I don't think it was an implied volatility chart. No, I don't think it was an implied volatility chart. I think you're talking about the chart. Well, let's go up and have a look. 56.28. Oh, okay. So that thing there. Okay. Now I got it. Let's find out where you are now. Okay. While you were explaining the companies advertising AI and experiencing price increase should theoretically have higher implied volatility on the call options. Well, I don't know that I was making that connection. What I was saying is that it wouldn't surprise me if you looked at the skew and found positive skew, if you found a volatility smile. I have noticed that this phenomena is primarily observed in the front month expiration. Yeah, probably. It's the most liquid. Could you explain the reason behind this observation being limited to the front month as opposed to the subsequent months where volatility appears to be following a volatility smile at best? Most of the volume will show up in the front month. Especially for short options. Well, there's a long side to every short side, right? So most of the volume in options shows up in the front month. Till about 10 days to expiration. Once you start to getting 10, 9, 8, you'll see them flow into the next month. Volume starts to pick up in the next month, and liquidity tends to improve in the next month. And then after the front month expires, then you get all the extra strike prices that show up in the month after. So the further out you go, the fewer strike prices there are. So if you look at SPY and you go out 6 months, you might have $10 strikes. 3 months, you might have $5 strikes, but the front month has $1 strikes. So depending on what it is you're doing, you might want more useful strikes. So the volume shows up in the front month. My understanding has been that volatility skew generally exhibits a bias towards the downside. I don't know what that means when you say skew exhibits a bias towards the downside. Given that people tend to be more concerned about potential downward movements, puts usually result in being priced higher than calls. At the index level, not at the stock level. Because if you are hedging a portfolio, you hedge with index options. In other words, it's called a macro hedge. So let's say I have 3 stocks, stock A, stock B, stock C. A micro hedge is I will sell puts on A, or if I'm doing so, I'll buy puts on A, I'll buy puts on B, I'll buy puts on C, or I could just say I will buy puts on SPX. And it will be one macro hedge for my entire portfolio. So the index is typically used to hedge the portfolio. However, it is not typically used for idiosyncratic risk to the upside. Here is where you would buy the call on A, buy the call on B, but I'm not going to buy a call on C. So you tend to buy calls, or the market tends to buy calls at individual name levels, but tends to buy insurance at the index level. And that is why the index most often has skew that looks like this, whereas underlying stocks tend to have this, or if they're under incredible momentum, they'll have something that looks like that. I have been taught that it is advisable to refrain from purchasing options when implied volatility is high. That is true, and instead consider buying them when IV is low. If you need to buy options, then yeah, buying them when it's low makes a lot of sense. It's like buying insurance for your house before the tornado shows up. If the tornado is 3 days away, you're going to pay a lot of money for your insurance policy, right? Insurance companies will sell you insurance when they feel the least amount of risk that you'll use it. In light of your explanation where you mentioned that buying call spreads can be cheaper, I'm beginning to question my understanding. Well, a call spread is buying a call and selling a call. If you're doing that, you're canceling out the implied volatility. Do you get that? Because both calls will be elevated in terms of the premium by the implied volatility. So if you're long a call and then at some higher price you're short the call, you're basically long and short something. The only difference you have left here really is a gamma and some slight, is the delta and some slight gamma, some slight theta. But the volatilities, for the most part, will cancel out to the point where it's not really a thing for you. That if volatility drops suddenly, yeah, it'll drop from your call, but it'll drop from this call as well, right? So we'll skip that. In the context of trading a call spread, I'd like to understand the rationale behind purchasing at the money call rather than in the money. You can. I mean, you can do that if you want. It's riskier. That's all it is. It's going to cost you more and it's riskier, but you can do it. Sure. You can set whatever delta you want, and you can set the strikes wherever you want them to be. Not a problem. Just the profit on the upside will be lower and your risk will be higher. So let's give an example of that. Let's say that a stock is at $100 and you're going to buy a 95 call and sell a 105 call. You're going to pay at least $5 for this, and then something else. So this part of it, this part of the spread, you're already paying for. You're already paying for it when you buy that call, right? You're already buying that part of your return. So what's the most you can make between 95 and 100? Exactly what you paid for it, which means your profit on this part can only be zero. The only real money you'll make is from 100 to 105. But you're going to pay at least 5 and change for this, and you're going to pay a little bit amount for this. So of the $10 spread, it wouldn't surprise me if you were paying like $7 to $8 for that $10 spread. Now, I think spreads make sense at 40%. So if you buy the 100 and sell the 110, that might cost you, $3 to $4 because, I don't know, make up a number for the 100. Let's say you pay 5 and on the 110, maybe you get $1.50, right? Well, you're paying $3.50, which is 35% of the spread. Once you're over 40%, it starts to get, expensive. Here, you'd probably be 70 to 80% of the spread. Now, you might think, but it only has to get to 105. Wouldn't that make a lot of sense? Here, got to get to 110. That if you were thinking about break evens, well, if I'm spending $350, my break even is 103.50. If I'm spending here, let's say $750, my break even is 102.50. I got a lower break even before I start making money. Sure, what happens if it finishes at 94? Here you lose $350. Here you lose $750, right? So you just lose more money. Now, some clever people might say, hang on, something's at 100. I'm looking at the 90 to 95 spread, and it's only $4.60. I can make an easy 40 cents for free unless this drops to $89. Then you lose the full $4.60, right? So you can set your strikes wherever you want, but remember, every time you get an advantage somewhere, you also get a disadvantage somewhere else. If an option only had nothing but advantages, there would be nothing but that until the advantages were gone. Let's see. If the debt ceiling increases as expected, how would that impact the supply of treasuries? It would increase the supply. Do you know what maturity the government issue debt on? Probably a lot of short-term, and more short-term than long-term, because there might be a belief that if interest rates are going to drop, if there is going to be a recession and rates are going to drop, why lock in 30-year treasuries yielding 4% if we can lock them in at 2.5% in 7 months? And this way here, they are issuing, in essence, floating rate debt when you issue T-bills. Because if you're redoing them every 3 months, you're reissuing them at whatever the rate is, and if the Treasury does expect a recession, then it makes more sense to keep your debt issuance short. But they are going to issue across the curve, but probably focus more on the short end of the curve. At least I think they would. My concern is that if government increases supply on the long end of the curve, which makes more sense to them since borrowing on the short end is more costly now, but on the long end may be more costly in the long term. That will push down the price of long-term Treasury. There's been a lot of research on this that shows that the difference between flow and stock, right? A flow is something that's going on. A stock is just a sum total of something. That if you have a curve that looks like this and you're issuing a lot of 30-year treasuries, you could get a yield that increases because it pushes down the price, but then after the issuance is over, it tends just to revert back to where it was. In other words, it doesn't care about the stock. It may be affected by the flow of issuance, but once issuance is done, it's pretty much done as well. I went to Costco the other day, and they always have stuff on sale. They had these bags, of Brookside dark chocolate with blueberry centers. So I'm about to eat one. So if you hear me enjoying something, it's not your questions. It's these chocolate-covered blueberries. Oh, that's just fantastic. Let's go on to the next one. It is interesting to me that part of the deal has some government cuts on spending. To me, that would signal a harder recession because there's less spending that goes into the economy. Not a cut on spending, it's a cut on the growth of spending. Spending will increase by 1% a year. So in other words, the G component of GDP will not get worse than what it is. So it's not as if you had a 5% cut to spending. Well, then that would be a bit of an issue. It's not that at all. Three quick questions. I only see one. I see 3 question marks. In what phase of the business cycle is the U.S.? I don't know how many times I've answered this now. Slowdown. Does market reaction to AI have potential to change it? I don't know that stock prices change the real economy. Unless they lead to a hiring boom, where every company says, we need data scientists, we need computer programmers. If it leads to a hiring boom, perhaps, but we're already in a tight job market anyways. I don't know where they're going to get these people. And if they do try to do that, it would lead to wage inflation, which would just push rates even higher. But the financial market itself, other than just creating a wealth effect that makes people feel richer, don't know that it has much effect on the real economy unless it leads to employment. What key indicators would you look at to detect the change? Well, I guess employment would be the obvious one to look at. You can't get all this stuff done without hiring people, right? QA session, okay. One question on an idea. Would shorting S&P 500 equal weight index while buying calls on QQQ be a good trade? I get what you're saying. Is that the equal weight won't be dominated by those 7 stocks that are showing momentum. But then you'd be buying an index that is probably dominated by those 7 stocks anyways, right? The QQQ 100. What weighting do those 7 have in the QQQ 100s? And maybe that is your intention, is to say, let's isolate those. You could short the S&P 500 and simply buy a certain number of shares of each of the 7. It could be 6 shares of this, 5 shares of that, 4 shares of that, to remove them. When you're short the index and you buy those underlyings, you are in effect removing them from the index without the baggage of the other 90 shares that would be in QQQ. But I get what you're doing. The momentum stocks would probably break harder than the other 597 stocks in the S&P 500 because they never really went up. So if there is a sell-off of 10%, that 10% would probably come from 20% coming from the top 7 and almost nothing coming from everyone else. Because if nothing from everyone else created the 10% rally, you see what I'm getting at? On your last screen, when return is negatively skewed, no. The skew is implied volatility. It's not return. The volatility is skewed, not the return. Premium received on bull spread is also higher than what it would be under normal implied volatility condition. Max loss for put spread is the distance of strikes, so the risk is also defined, yeah. While for bull call spread, max loss is the premium paid up front, yeah. But there will be negative theta for the trade, yep. Both strategies will not work when underlying goes down. Nope. It occurs to me that bull call only works if underlying go up, while bull put will work. No, a bull put will not work if the underlying goes up. You got to pay attention to the word bull. A bull put is you sold the put and then you bought a put further in the money. If the stock price goes down, you lose. So why isn't bull put the preferred strategy under current market conditions when nobody knows when momentum is going to run out of steam? Well, you lose both ways. That's why. You're thinking that you win if the stock price goes down and you're using puts to win, it must be a bear spread, not a bull spread. If you're using a bull spread with puts, what you're doing is you're selling a put, then you're going further lower in price and you're buying a put. So you'll get a credit because this premium will be higher than this. You might get, let's say, $2, and your risk might be $5. And if the price drops, well, then you're down $500. You got paid $200 to lose $500. You still lose $300. You still lose money. And this is a bull spread because you need the price to stay above that strike. That's why it's bullish. Does anyone know how to calculate the probability of rate hikes? CME FedWatch tool. Do you see any assets being used as a source of funds for AI becoming attractive in the sell-off? Who knows? I mean, who knows, right? I've seen commodities are down nicely. That's mostly on China. Their economic recovery does not seem like what everybody thought it would be. The economy's opening up. It's going to be fantastic. And turns out, not so much. It's the factory to the world. And when the world is in a slow growth environment, duh, what do you think China is? Duh, right? So don't underestimate the PBOC on this one. And, if growth seems to be getting too low for them to provide stimulus, don't underestimate that. Because the stimulus doesn't actually have to do anything. Just the announcement of it would be enough to cause a rally until the evidence showed that it doesn't work, which could take 30 days or 60 days. Just the announcement of it could cause a rally, right? Remember, there's an asymmetry in the market when it comes to information. The hope of good information is enough to send stocks down, but the risk of bad information, somebody will fix it. It'll be taken care of. It won't really happen, will it? Right? So, Second, Treasury will issue about 700 billion treasuries post debt ceiling resolution. How do you see this affecting TLT? I do not. I have a question on options. I have a stock that I purchased at a break-even of 160, currently trading at 145. Okay, so, here's the thing. If you come to me and say, how do I stay out of jail? I'll tell you how to stay out of jail. But once you commit the crime and you're about to be sentenced, if you say to me, how do I stay out of jail? That's not a question anymore. You're going to jail. The question is, how do you build a life for yourself in jail? That's the question now, is what do you do now? But there is once you're in trouble, it's over. You want to stay out of trouble. So let me show you how this is done. You sell a put, and you decide that your delta is on the put is going to be negative 0.3. Well, negative means you got positive 0.3 delta at that point, right? And when you do it, you set a limit. You say, as soon as this gets to negative 0.5 delta, as soon as it gets to negative 0.5, what I'm going to do is I'm going to rebalance it back to the 30. You, at 160 down to 145, you let it get to maybe 0.8, right? So rebalancing back can minimize your loss, but it won't avoid your loss. So if you're at a 0.5 to get back to 0.3, well, what do you have to do? You have to reduce that delta somehow, which means you need to either short some of the underlying because you're negative the put, which means you have 0.5 delta. You got to get it to 0.3. The easiest thing to do is short 20 shares, and you'll be back to your 0.3. Before you get into any trouble, because as the stock keeps falling, yeah, your put will add up losses, but these 20 shares now are working for you. You're back to the 30 put, or the 30 delta. You have to keep rebalancing back to where you want to be. So you have to have some rebalancing range, whether it be 0.5 or 0.6, where you say, as soon as this gets to 0.6, I am going to rebalance back to something. Or you could say, I got $2 for this. As soon as this thing hits $4, I'm out. And just cut your losses. You could do that. All right, so you can't wait until you're in trouble and then ask me how to get out. You have to ask me, how do I avoid trouble to begin with? And when you put your trade on, you should know what your exit rule is and what your rebalancing rule is. If you don't, you're trading on hope. You're hoping that it'll work out. So right now I could create a synthetic long position at the same break even for a credit at 160, and you risk it being put to you. You'll risk it being put to you, which means you're right back to where you started, right? And if you have a synthetic long position, you have the stock. Oh, I thought you had it. Well, hang on. You bought the stock at 160. It's at 145. You want to create a synthetic long at 160. But now you have twice the amount of shares. Unless you're saying sell the 100 shares, or sell the shares you have at 145 and create a synthetic long at 160. Would it make sense to sell my position at a loss and create that synthetic at a small credit? Using IBKR, it would simply consume margin, free a lot of capital, and generate a small premium. Yeah, you would. You'd generate some premium, but I would not create a synthetic out of that, because the premium that you would generate would be given away in buying the call. Simply sell the put. Simply sell the 160 put. You can do that, and you'll be okay. Just sell the 160 put. Don't bother buying the call. This strategy makes sense. Where in IBKR could I actually see visually the distribution as you are showing with call spread strategy? Well, you can't. I mean, it doesn't break it down for you like that. That was an educational tool that I used by showing you that distribution. What you'll see in IBKR is just the skew, a chart of the skew. I think somebody is coming down the stairs right now as quietly as they possibly can. I see them reaching for my chocolate-covered blueberries, of which they cannot have. Get out of here. Do you want to say hi? Hello. Did everybody hear that? Come closer and say hello to everybody. Introduce yourself. This is my new employee.
Hey guys, it's Naomi.
Huh? Yeah? Oh, that was it? You had more to say? Go ahead.
I'm learning to become Mark Meldrum.
Yeah, my apprentice. All right. Okay, let's keep going here. I got to tell you, Brookside, it was at Costco. You know why I bought them? They were on sale. I'm a sucker for that. I see $3 off. I think I'm saving $3. The more you spend, the more you save, right? I'm rolling over my June short ES position. I already have some September ES shorts and positive beta and others. I was thinking of selling a short straddle for the June 16th expiration on the September underlying. If it finishes below the strike, I keep the call premium. Puts are assigned, but will be close to my existing September shorts at a great price. My June shorts expire at an okay price. If it finishes above the strike, I'll have successfully raised my average June price with the put premium. It will be assigned September short position. I'm trying to think of what you're doing here. So you have a short June ES. Let me just draw it out so that I have it in my head. You're short an ES for June. And you're going out to the June 16th expiration, which has both a June and a September underlying. You want to take the September contract on this one. Okay, so here's the deal with this. If you look at the June and the Septembers, right, the June will be priced here and the September will be priced here. There's a difference of about, I think, $42 between the June and the September. So if you're looking at, let's say, a 41.80 put, the premium will be higher here on the June contract than it will be on the September contract, because the September will be $42 higher than the June price, making the premium on this rather low. Because the premiums between, even though these are both June 16th, the premium difference between the June and September will reflect the difference in carry between the June and September. So I'm not sure if you accounted for that in what it is that you were doing. If you're selling on the June 16th with the September underlying, you must pay attention to the September price. The easiest way, I think, to get something done is to imagine that you've rolled over into September. And you'll have a pickup of 42 points right away if you roll your June into September. You'll have a pickup of 42 points. And if you did that, what happens to your break-even price on your June ES? And then use that break-even price to set your strike price for September. So let's say it was 41.50, and what you want to do is sell a put and sell a call. If it's above 41.50, it's called away from you. If you're already short June and it's called away from you, you will double you will have more of a short position. All right? Yeah, you're thinking of selling short straddle for June, but you haven't rolled over your June yet. If you do roll over your June to September and then sell a straddle on June and it's above, you end up with even more short position, because a long position will be called away from you, but you're already short. You have no long position, so you'll just be even more short. There's maybe what you're missing. Instead of throwing in the towel on your SPY trades, I didn't throw in the towel. I didn't say I was going to throw in the towel. I said I was going to get neutral, right? You can get neutral a whole bunch of ways. You can get neutral by adding beta at the stock level. The way I did it today, I added some beta at the stock level. I sold some puts on a bunch of things, and I sold some puts on PLD and in DLR, Digital Realty Trust, data centers. Good businesses with good cash flows and good business models. So I sold some puts there to add beta. Then with my ES position, I had some June, I had some September that are short. And then I had a whole bunch of puts that I had sold. So what I did was I said, okay, well, these have a certain type of payoff, right? So that, let's say that this is the strike price of the put. That's the most you can make. And then you start to lose money after that, right? But the closer you get to expiration, they still have convexity that looks like this. So the stock price is way up here, meaning that there's very little gain for me left to make. But if June ES goes up, I lose, for each contract, you lose $50 a point, but I am not gaining $50 a point on the puts anymore. So I could do a number of things. I could roll these forward, roll them all forward. I could do that, and I'd get a pickup of about 30 to 40 points on these puts. But it still wouldn't change very much. So what I did was I closed a number of puts, and I had a certain dollar gain. Then I divided that. I took my June, I divided my total underwater position, divided it by the number of contracts I had, so I knew how much I was negative per contract. Then I closed enough contracts to offset my gains such that I had zero gain, zero loss. I did that, and it brings me closer to being neutral. So I didn't abandon it. I reduced the size of it by offsetting gains and losses. That's all I did, so that in the net, my unrealized loss on my entire ES position remained the same, but I gained about 50, 60 points of upside protection by getting rid of the low convexity, or the things that had, very low convexity at that point. The low convexity puts that weren't going to help me very much if the market continued to go up. And if the market went down, well, those puts would just inflate in value. So all I did was I reduced the size of what I had, and I added some positive beta in a number of places. What else did I do today? I did some commodities trades. I might explain one of those on Sunday. I like your bullish thesis for mining copper for the next cycle. Do you care to comment on what thesis you invested in for previous cycles? REITs, really, I was mostly concentrated in REITs for the longest time. Because they had, I think, a 10, 15 year outperformance of the S&P 500. They just continued to perform every year. And I'm talking over a period of time. They didn't outperform every single year, but over that holding period, they outperformed. I was in REITs. I would probably get back in there again, but after a significant clear out of commercial real estate. There has to be I think a significant period of pain before I'd want to get back in. An acquaintance sold a call of 300 on Nvidia May 16th before the report, and now he has a good loss. Well, is there such a thing as a good loss? He has a bad loss, a very bad loss, but he expects that Nvidia will decrease. Well, yeah, that is hope, and hope is not a strategy. This is stupid of him, but what would you advise in such a situation? Move on. It went up again today. And as soon as it becomes a Wall Street's bet stock, as soon as it becomes a trending stock, as soon as it becomes a Robinhood stock, there is no end to where it can go, because the less experience the trader, the less they care about fundamentals, the less they care about valuation, and the only thing that will matter is it has gone up, it's been going up, it will continue to go up, I will buy it at this price and sell it higher. And that's momentum. Momentum, these are not long-term holders. They don't care about the valuation because they're not holding it for a long period of time. They're riding a wave. All waves break. And they all think they can hop off the wave before it breaks, but momentum can crush them before it breaks. You run out of capital before it breaks. Just move on. Move on. Shouldn't have done that anyways, especially on high volatility stocks. That is a dangerous, dangerous place to be. Wouldn't AI be deflationary in the long run? Labor costs go down, short run boost to profits, but then competition on price. How long is a long run? Keynes, I think, once said, the market can stay irrational longer than you can stay solvent, and in the long run, we're all dead anyways. The long run could be 10 years. What was a long run for .com? The rally lasted 14 months. This rally's really just started. You can say, okay, well, we can trace the rally back to January. Well, we're 5 months into it. Can you imagine if this continued on again for another 9 months and produced the same 30% every 5 months? That's what NASDAQ did. 1999, almost a 100% gain in the NASDAQ in 1 year. Now, I'm not saying that's going to happen, but it has before, and the hype at the time is the same flavor as the hype now. It is a legitimate technology that you can see changing a lot of things, but the story will be that it will change everything, and you can't fight that kind of story. So yeah, it could be deflationary in the long run, but when is the long run? It could be quite some time. I'd like to hear your thoughts about the price of wheat. I did answer this one according to Barron's article. Russian wheat is still selling, and Russian exports of wheat is up. And so if you saw the price action this morning, it was down. I read the news feed every morning when I wake up. I just scroll through the news feed, and I saw that one, Russian wheat hitting the market. I thought, well, duh. You know, Russia's doing just fine because there are countries that are willing to still do business with Russia. You know, so it's, you know, their oil is selling, their wheat is selling, their palladium is selling. They're going to do just fine. Not as great as they could be doing, but they have customers. So if you're looking at December wheat, for example, because you have to go past the harvest. If you think it's going to, this is the thing with ag futures, you can't just bet on July's wheat. That's coming from inventory. What if inventories are very good based on the current wheat, but that the harvest is going to suck? Well, you're going to have to wait till September, October. So you're probably looking at December wheat was down quite significantly today, from 640 down to 626. Is that the end of it? I don't know. And making a prediction about what the summer is going to be like for growing conditions, well, that's just a prediction. You don't know. Nobody knows. What did Yogi Berra say? Predictions are difficult, especially about the future. I laugh every time I hear that because, well, I mean, wouldn't it be great to just have hung out around that guy who kept saying stuff like that, giving you those little chuckles every day? He once said about a restaurant, nobody ever goes there anymore. It's too crowded. I don't know if he actually said all those things, or if just whenever you think of something ironic, you just attribute it to this guy. Why investors are not compensated for bearing non-systematic risk? Because you can diversify it away. If I had NVIDIA in my portfolio a month ago versus me, wouldn't I be deemed to be rewarded? Yeah, you would have been deemed to have been rewarded for that decision. But when we say that you are not rewarded for idiosyncratic risk, it means that the individual stock will not price itself or will not use a discount rate that assumes that there is excess return for being in that stock. If you are in that stock, then you have alpha, or at least some form of it. But because you can diversify away idiosyncratic risk, the theory, and let's stress it is the theory says you will not be compensated for that. But we all know that, yeah, we can do better or worse if we overweight. If the benchmark has NVIDIA and we overweight NVIDIA, we beat the benchmark, right? Our decision to overweight produced some alpha. Are the live sessions recorded for replay? No, they are not. You're asking about the any live session I do for Q&A for either the CFA program or the Applied Series. No, it's not. Because you get a suboptimal equilibrium when you record them. So when you don't record them, people show up. And when people show up, they ask questions and you have great sessions. When you record them, people don't show up because they say, I'll just watch them later. And when they don't show up, nobody asks questions, there's nothing to record, everybody loses. So you end up in a Nash equilibrium, which is suboptimal, and you can change everybody's behavior by making it rare. In other words, it only happens at this time for this period of time, and that's it, and you can't watch it later. If you make it plentiful by recording it and allowing people to watch it at any time, you actually reduce the quality of what it is you're producing, because if you need people to show up to make it good, you gotta make them show up, which means you can't have other options. So no, they're not recorded. Last week, Rick Reeder mentioned an area of opportunity seeing in Mexican sovereign debt. The Mexican 10-year government bond yield 9%. I don't even think you have to go out to the 10-year to get 9%. What's their short-term yielding? Almost 7.5%. Going out another year and a half to squeeze another 150 points out, but maybe he wants the duration. Curious to hear your stance on this with your bullish position on the peso, with Mexico having an S&P rating of BBB. Can you compare this to a 10-year BBB U.S. corporate bond of 5.7? Well, they have higher yields to begin with, right? You have country risk when you are in Mexico, although I do think that country risk is rather lower than maybe BBB. Not lower rating, lower risk than what BBB would imply, because I think as they start getting more FDI, more foreign direct investment, it will improve the credit quality of the whole country. But yeah, I don't think that when I was talking about the Mexican peso, it seems to be the most quiet trade out there, that nobody seems to be talking about the success of this little guy. But the Mexican peso has outperformed the US dollar. As you know, even when US dollar was king dollar and going up and up, and everyone's saying, look at the dollar, the peso was still doing better, and you hardly heard anything about it. And I'm looking at it thinking, why is no one talking about this? But I think the peso continues to outperform because it makes a lot of sense, given that their labor costs are lower than China's labor costs, and you don't have an ocean to cross. I mean, come on, it's right there, right? Yeah, I agree with him. Mexico's a good place to look right now. How much have past debt ceiling issues impacted the G component of GDP? Wondering this effect this may have on GDP, with G making up roughly 25%. I don't know that answer, but I'm going to go ahead and say minimal, altogether minimal. Because no one ever really cuts spending. It's politically difficult to do. The party in charge never wants to cut spending. And the party in opposition wants to until they're the party in charge. Then they don't want to cut spending. So it usually just goes up. So I don't know that it's had much of an effect on Y. I think the only time it has an effect on Y is when a war ends. And they're not spending money on supporting a military at that point, or a larger military. Wall Street Journal did a good map in an article called "Why Are Markets So Calm?" Revenge of the quant funds, suggesting that quant funds play a significant role in the current bullish market. I can believe that. A quant fund will execute an algorithm based on rules. It will not stop to think if it makes any sense. If it satisfies certain rules, that's a done deal. So if one of the rules is, buy stocks above their 10-day moving average, sell stocks below their 10-day moving average, you could get momentum in small pockets like that could end up becoming detached from their valuations and detached from the economic fundamentals altogether, depending on what the algorithm is scanning for. Could you give your perspective on the impact of quant funds on the current market behavior? Well, earlier in this Q&A, I did say to Naomi today, I said, I don't think I'm trading against humans anymore, because there are some clear contradictions here that just don't make sense. That somebody somewhere would step in and say, well, this is not making any sense, that the direction of these two prices make no sense at all. Somebody would have stepped in, unless, of course, you're a machine executing a set of rules and stepping in is outside of the rules. of what you are executing. But yeah, earlier in the morning, 10:30, 11, I'm looking at it going, I don't think I'm playing against humans, because I don't think humans would make these egregious mistakes. Could you please provide further clarification regarding the concept of speed in the context of market disruptions or the bursting of a bubble? It is often mentioned that such events occur fast, but what precisely does fast mean? It means that everything is fine until you wake up Friday morning, then nobody wants anything to do with it. And in fact, you can't get out of it fast enough because nobody wants anything to do with it, and everyone changed their mind almost right away. And usually it takes one event for it to happen. The more momentum you had, the faster the break. Momentum is fun. The expression momentum is your friend until the end. And when it breaks fast. So it is a game of hot potato. And that's what NVIDIA is right now. It's a hot potato. You buy it at 402, you hope to sell it at 408. Somebody buys it at 408, they hope to sell it to 415. You sold it at 408, you saw it to go 415, it pulls back to 412, you jump back in hoping to sell it for 416, and you keep churning and churning and churning and churning like that. Well, hot potato, somebody somewhere holds it when it's over, right? So when the music stops, there are a bunch of people who are going to be holding that hot potato, and they're going to try to throw it around to other people. And it's the smart ones that will get out before the end and not be sucked back in. The rookies will usually keep buying, and when it pulls back, they'll buy a little more. If it pulls back, they'll buy a little more, and they'll start getting excited that they got it at such a good price until it just keeps dropping and dropping and dropping, and it crushes them. And this will crush a lot of people. When? I don't know. At what price? I don't know. But I know it will. They cannot possibly grow into their valuation at this point. What were some of the examples I heard? That they would have to be 100% of the market for something like how many years if they don't go any higher in price just to return money to shareholders. It can't be done. It simply can't be done. So it is a game of hot potato right now, not a valuation play. Could you please provide further clarification? Okay, I already did that. If we cannot predict such an event will occur, well, you can predict that a momentum will break. I predict NVIDIA's momentum will break. When? I don't know. At what price? I don't know. Can we enter into the decline as soon as we become aware of its commencement? How do you know it's not just a pullback? That's the thing, right? I mean, when you have no advantage, don't play the game. And on something like this, don't play the game. You have no advantage, don't play the game. Next debt ceiling deal will likely occur January 25. Considering the significant increase in credit default price this time, assuming the credit default price will surge again January 25, what would be the most advantageous approach to capitalize on this situation? Questionable whether or not you could participate in the CDS market, because it is OTC and you are probably not a qualified counterparty, nor would you come heavy enough with the size needed to get it done. CDS means you got to pay the other side a premium. Every quarter you got to make a payment, which means you're a credit risk. Well, who are you? Why should I take on the credit risk of you? So it's questionable whether or not you can even participate in the CDS market. Why is QQQ price so different from NASDAQ 100, unlike SPY to S&P 500 or DIA to Dow Jones? Well, they're different, right? SPY is usually about 1/10 of SPX. DIA is about 1/100th of the Dow Jones, DGIA. And QQQ is around 1/40th of NQ, the NASDAQ. So they're all different. They're not the same. They all have different relationships, and that's to keep them in a tradable price, right? You want them in a tradable price so that it doesn't cost you, $350,000 to buy 100 shares. So AI is like the new crypto. Like when anyone mentioning crypto, they were getting plus 10% intraday. Yeah. What's going on with Alcoa at the moment? Aluminum prices. Aluminum prices in China. Aluminum prices are down 10% over the last month. I've been using it as one of my income factories, but I'm curious about the big downward moves in the past couple of days. Yeah, it's soft aluminum prices. soft aluminum prices, and China. At the moment, my main strategy is doing income factories on a variety of underlyings with high IV. As well, you got high IV, you got to expect that every now and then it's going to hurt you, right? That has been mostly trading in ranges, and this has been working well with this strategy. What do you do if the overall market level drops significantly and all your puts get assigned? You have a small part of your portfolio. That's why you size your income strategy by theta and have theta no more than 0.1 or 0.2% of your portfolio on a very safe level. If we have a confirmed bull market and things are going up, move your theta to 0.4, 0.5% of your portfolio. But when you're 0.2 and things go against you, it's okay. They're good underlyings. You don't mind owning them. And when you own them, when they're put to you, you can then start selling calls on them, right? So you have some way out of it as long as the underlyings are good. You haven't gone crazy on deciding that you want all of your portfolio inputs. Yeah, you're going to get crushed. That's why you size it by theta. Let's see. We're almost done here. As far as dabbling in Canadian REITs, are you taking into account the difference in the provincial tribunals dealing with landlord? No, I don't really care about that. The REITs have a incredibly good screening process before you can rent. The credit checks that are involved, so they do a lot of screening before you can even rent. And I'm not saying they don't have problems, but people who want to cause a problem, like if I want to get free rent and I want to be difficult, I'm not going to one of these institutional landlords. No way. They'll crush me because they'll never let me go. They'll crush me. I'm going to somebody who owns a duplex or a triplex, because you don't have the resources to fight me, and I'll live rent-free for a year while you try to evict me, and I know how to do it. I know how to delay and delay and delay, and you can't do a damn thing. But institutionals, they got big lawyers. I'm not going up against that. You can't afford a lawyer. I'll use you. I'll hurt you, but I'm not going to hurt one of those big guys because I will get hurt. I know you did Shaolin in the past. Have you ever thought taking up Brazilian Jiu-Jitsu? At my age, I am what I am. It is not a thing that I really care about at this point in time. I'm not going to compete. When you're young, when you're a teenager and going into your 20s, it's a thing, right? It's a thing. It's part of your identity as whatever it is that you feel. It's just, something you want to do. When you get a little bit older, you get to an age where, that just doesn't matter anymore. I know what I know. I can handle myself. I do what I do, and that's it. I'm never going to compete. It's not really something I care to do. The physical cardio strength training aspect of it, yeah. I mean, that sounds fun, but, I don't know. You will find, maybe some of you recognize this, that when you go to training centers, there's always that group in there, not everyone, but there's that group there that feel they need to prove something. And I am not about to spar with some 25-year-old who wants to prove something. You know what I mean? I'm just not going to do it. So, no, at this point, I would say when it comes to the arts, the martial arts sports, I am what I am today, and that's it. I'm good. What dog breeds are you looking for your next dog? Dachshund. Nice little black and brown Dachshund. They're so cute, and they don't require that much walking. The lab I had, it was 4 hours a day, high energy, 4 hours a day for age 2, 3, 4, 5, 6. Not until age 6 did he start slowing down. It went from 15 miles a day down to 12. Then it was there for a year before it dropped to 10 miles and 8 miles. It was a lot of time. A Dashan can't do a 2-mile walk. They just can't do a 2-mile walk on those tiny little legs. So probably something like that. What is your opinion of selling a put vertical spread against a losing call vertical spread similar to, that's just too much abstractness for me to even begin to give an answer. Like when you say it's a losing, how much of a losing one? What's the underlying? What's the direction of the underlying? I can't even begin to answer that without asking a whole bunch of other questions. It seems to me there's an easier way to get this done. You might be just trying to get too fancy and too complicated. And this is going back to the Shaolin up here and the boxing. This was the difference between the two. One of them just tried to get fancy. The other one just punched you in the face. Maybe what you need here is a punch in the face. Not you, but I mean, like, your position you just need something simple like a good punch in the face, as opposed to getting fancy by selling a vertical spread against this vertical spread to see what happens. It could be just a matter of, it comes down to a simple thing. When something's working against you, you rebalance to a lower exposure, period. And usually the simplest way to get it done is the best way to get it done. Don't get fancy. Never mind this multiple leg strategies that you want to do. The easiest way to stop the pain is to lower your exposure. Find something that lowers your exposure and be done with it. But this is too abstract and it requires too many follow-up questions to figure out what's going on. What's your opinion on gold, short and medium term? I have no opinion on gold. I've never had an opinion on gold. Never. It's just not my thing. I'm short the market. But January 24, 403 puts, and the market is moving against me. What can I do to get neutral? How do I get out of this hole? Well, if you bought the 403 puts, you would have initially had a negative delta. What was it? Let's say it was 50 delta, right? Let's say that was the 50 delta, and now it is a negative 20 delta because you bought it, which means the delta dropping is not what you want to see. You would have rather the delta went higher. So you got to get your delta back up somehow. And if the market is moving on you, the best way to go from negative 20 to negative 50 is figure out a way to get your delta up. That's the easiest thing to do. Now, you should have been doing this along the way and rebalancing along the way. But, you didn't, so I don't know. How do you get it? Well, you bought. It's January 2024. Hang on. You got time. Relax. Give it time. The pathway, who cares about the pathway? You only care about the destination. Do you believe that something will happen later this year that will cause the market to sell off, or that rationality will arrive in the market? So if you think the Fed has got 2, maybe 3 more rate hikes, if labor numbers this week come in hotter than expected, then yeah, there could be 2, 3 more rate hikes. If you think the economy is going to fall apart because, commodities and commodity producers are trading as if they are heading into a recession now, then you got time. This is January 2024. Calm. Be calm. Be calm. Don't worry about getting neutral at this point. Just wait. Just give it time. You said you're watching the morning show. Could you share which shows do you watch? Surveillance? Well, the Open starts at 9. I watch the 7 to 9 show, and then I watch the Open. Somewhere around 10 o'clock, it just starts to get repetitive and boring, so I stop watching at that point. Or I just hit, or it's on in the background, and I'm not really watching it intently. Let's see. Not doing the SPY section this time around. I did explain why I wasn't doing the SPY section, why his agency Balance sheet constantly shrinking because the price of, as rates go up, the price of financial assets go down. And that's the end of it. Okay, we are done.